Asian shares were mixed after solid Chinese trade data added to signs that domestic demand is picking up. Chinese customs data showed that imports jumped 8.4% in April from a year ago, beating the expectation for a rise of 4.8%. The yen stabilized after 3 days of declines as Japan talked up potential currency interventions. And the Bank of England has held interest rates at 5.25% for the 6th successive meeting, despite growing evidence that inflation is under control. Hong Kong's Hang Seng Index advanced 1.2%, mainland China's Shanghai Index climbed 0.8%, and Japan's Nikkei shed 0.3%. U.S. markets are looking for some form of leadership, either fresh leadership or new leadership, or some kind of key signal. The Dow Jones Industrial Average closed yesterday higher as investors kept betting for supportive U.S. monetary policy. The other Wall Street benchmarks cooled a touch as momentum stalled and U.S. Treasury yields rose on the day of a 10-year notes auction. There was not much news to move the indexes outside of reports from individual companies. The S&P 500 was a tad lower, the Nasdaq Composite lost 0.2%, and the Dow Jones Industrial Average rose 0.4%. To give us more perspective on the markets, we are joined by Ricardo Smith, who is the Chief Investment Officer at ABSA Investments. Ricardo, thank you so much for your time. Let's start off by looking at local earnings and starting off with SABC that released their numbers. The share price right now is down 3.6%. What did you make of the results?
Afternoon. More or less, the result is in line. Earnings per share are quite down significantly, but that's, a lot of it due to some of the specialized items, which grew by about 10% odd. Really, some of the negativity from the market reaction is around forward guidance, looking, to shut down some productions for maintenance, which will affect production. Also, some negativity there around the growth in debt, so growing by about 10%. It is slightly more indebted than some of its competitors, and it's not necessarily a good time to be raising debt where we are seeing this environment of elevated interest rates. On a year-to-date basis, the stock is still up, so that's worth noting, up double-digit territory. So just pulling back a bit, from the earlier returns.
Let's have a global view right now. I mean, you look at the movement in U.S. bond yields. What signal are you taking from that?
They certainly have been a bit volatile. I think, pinning it down to where the turning point of rates is proving a lot more challenging than a lot of market participants would have anticipated. And so, we did see them last year peaking at about 5%, rallying down to 4%, and now kind of sitting somewhere around 4.5, as we are expecting fewer rate cuts this year and being pushed further and further outward. I think if we take a longer-term view on government bonds, certainly there's a lot of room for yield compression from current levels. If you believe the long-term forecast of about 2.5% in the short end, although not expecting the 10-year to get to that level, probably around 4 or 3.5% at the most. So there is some value in bonds, but we do think that in the short term, we should expect this kind of volatility as we hit a bit of a pivot in monetary policy stance.
Within the team, have you revised your rate cut expectations over the past couple of weeks or so, given the data that's come through?
We certainly have. We were not as optimistic as a lot of market participants, so we were already expecting between 25 and 50 basis points this year, and we're expecting that in Q3, where a lot of market participants coming into the year were expecting as much as 100 basis points. Having said that, we have slightly revised it, still expecting 1 or 2, but leaning more to 1 than 2, and really starting to expect it in the fourth quarter rather than the third quarter, then a few more rate cuts to come next year. And so pinning down, when that rate cut, first appear is a lot more difficult than, taking the view from an asset allocation and investment strategy perspective to say, look, we don't know when the first cut will come, but certainly over the next 3 years, we do believe that rates will be lower than current.
Let's talk about something a little more exciting. How are you playing the AI theme within your holdings or your portfolio outside of holding the likes of a Meta?
Yeah, for sure. So we've got a couple of counters in our portfolios, which does offer quite a lot of participation in AI, but a bit of diversification. The one counter is Microsoft. It is, its ChatGPT is, a leader in the space, but also, its software services is of an annuity basis and long-term contracting. So it's got a mode status in that effect. We've got Alphabet, which is the leading, stream provider, and a bit of threat, potential threat from Microsoft, but still, leading and coming up, with their own GPT, which is Bard. Not keeping up as much, but they've certainly got some time to figure it out. We're holding Micron Technology, which is a semiconductor counter. It's recently interlocked with NVIDIA, providing some chips into some of the AI chips that NVIDIA creates, and it's done pretty well. And it had better valuations than NVIDIA. And one other counter one thinks of is something like an Amazon, which its cloud servicing business quite important for cloud storage and computing of AI. So we've got quite a few counters and stocks within the AI theme outside of some of the players that you would think of.
If you had to look at one risk that you're paying attention to, whether it's local or abroad, what is it?
Yeah, one risk is very hard. I think there's certainly a lot of risks. I think the biggest risk in global markets is the potential of a recession. If the Fed holds off cutting rates for too long, then we may start to see some cracks in the system. And on the back of that is sticky inflation and geopolitical tension. So if those ease, we'd expect that to ease. I think locally, one thing that's on top of mind for everyone is elections. But in particular, from our perspective, we think that the policy uncertainty that comes with the uncertainty around politics is probably something we're thinking about and navigating. We're not predicting any doomsday event, but it certainly is something that we are monitoring quite closely, particularly with a heightened level of uncertainty around this election.
Ricardo, thank you so much for your time. Perhaps next time we can talk about how are you positioning for elections, not just the US side, but also locally as well. But thank you so much for joining us this afternoon. That is Ricardo Smith. He's the Chief Investment Officer at ABSA Investments.